Hi, my name is Sal Mendoza, and welcome back to Money Script Monday. Today, we're going to be talking about the hidden dangers of premium finance and how to address them. But before we get started, what is premium finance? Premium finance, really, at the end of the day, is a funding methodology. Kind of like, let's say that you were driving around and your car was getting kind of old. So all of a sudden, you were in the market for a new car, and all of a sudden, you saw a beautiful BMW. And so you went to the lot, you talked to the sales rep there, the car salesman, and all of a sudden you find out that price tag is $50,000. Well, really, at the end of the day, you have two ways of paying for that. You can go ahead and liquidate some assets and pay $50,000 up front, or maybe what you can do is go to your local credit union and pay that over the next 6 years. And because you have a great FICO score and all the other factors that a bank is looking for, maybe you're only paying maybe you're paying a point and a quarter, a point and a half. This way, you're not liquidating your assets, and your assets are, getting 9, 10, 11, 12% out in the market. That's the same thing as premium finance. The reason I decided to do the dangers of premium finance is not too long ago, I was working on a very substantial case. And when I say substantial, we're talking about a death benefit, 30 million plus, and very large premiums going into the policy. Now, I was working with the vendor that we work with, who's fantastic, and we had modeled it 6, 7 different times for the CPA and for the attorney, because at the end of the day, they have to write off. If they don't agree, there's a chance you're not going to get this policy in force. So finally, we were getting to that stage where we were about to get that yes, when all of a sudden I get a call, and it was a panic call, and it was from the agent, and he said, "We have a problem." And I said, "What is the problem?" He goes, "Another agent is aware of this case and he wants to participate, and the client has said yes." And so he was panicking. I was not panicking. The reason that I wasn't panicking is that I've been in premium finance now for a while. I know the vendors out there, I know the carriers out there, and of course the unknown was who the agent was, right? So once I found out who the agent was and I did some background on him, and I knew who the carriers were in the space, and once that came to fruition, and then of course who the premium finance model was. Once I knew who that was and he gave me that information, I was not concerned anymore, because I knew that premium finance model was very flawed from the inception because of the dangers and the risk that this particular company took in order to win the business. And so once we formulated a plan and we got the client, the CPA, and the attorney, and we explained, we actually ended up winning the case, putting it in force, and that commission to that agent was over $650,000. So let's move on a little bit. We always want to talk about the qualifications of a client that is looking into a premium finance. The first thing is going to be your net worth. We want a client. We have different kinds of models, but the model that I'm going to be specifically addressing today is a model that the net worth has to be at least $5 million. Now, if that particular insured is making $600,000-700,000, we can drop that down to $4 million net worth. Let's say he's a doctor and he's been in school for a long time. Maybe it's only his 4th year and he's just kind of ramping up the practice. We can get away with that kind of stuff. The second is leverage. Usually when you're working in that particular arena, that person needs to understand that we're going to be using OPM, other people's money. In this particular case, we're going to be using money from a bank. And so, the client has to be aware that if you're going to be borrowing money from a bank, well, you're going to have to put up some collateral. That's usually the way it works. Annual reviews. Annual reviews are mandatory in premium finance. This is not a transactional sale where you sell someone a 30-year term and you can kind of like, we'll see you in 30 years. This is more like, every year we need to sit down with the client. We need to go over the performance of the product and also find out if we're going to have to put up some more collateral. Liquidity. If there is more collateral, we have to be able to have that liquidity immediately. This is not something that is, hey, where am I going to borrow this money? This money has to be attainable today, if not tomorrow. Downside risk. Like anything else in the world of premium finance, Look at it like like in Florida. In Florida, there is a stage 5 hurricane that hits every once in a while. And when it does, we don't know where it's going to hit and when it's going to hit. Well, it's the same thing in premium finance, but it's called the economy. In the economy, every so often, there's going to be a major pullback. This particular premium finance has to be built with walls that are at least 4 feet deep. And so when we build these, we risk model this thing over and over and over so that it can take a beating from a stage 5 hurricane. And then lastly, which I believe is one of the most important things for the client, is that, remember the mechanism that I told you about the BMW? He has the money that he can liquidate and pay it off, or you know what? He doesn't want to liquidate his money. He's going to go to a bank and borrow that money. In premium finance, you want to have a client that has the ability that if the worst scenario came, he could still pull the money out of his assets and pay the premium and keep that policy in force. Okay, let's continue to move on. Now we're going to get into the dangers of premium finance. And the first is what we call the exit strategy. And the exit strategy is very, very important. There's a lot of different premium finance models out in the market today, but only a very few of them, have been tested. And the ones that are tested the best from a risk modeling perspective are the ones that get out of the commercial bank as soon as possible. In other words, they're going to pay the bank off in year 10 or year 11 or year 12, depending on the performance. If everything works out, we want out within 10 years. We don't want, like some of these models, that the exit strategy is death. There is so much risk involved in that. Okay, let's move on into, we want to communicate. Communicating to the client about not rolling up interest is not only important from a verbal perspective, but we want to be sure that we actually get it in writing. We don't want to be rolling up interest. We don't want to be any kind associated with any kind of free insurance. We want the client to participate in that. In fact, we want to make sure that they're not only paying for it, okay, but we actually want them to pay a little bit of principal. So in other words, we actually want them to pay all of the interest and just a little bit of the principal, because if we do that, we're able to bring some of the collateral that they're going to need down significantly, down sometimes even 40-45%. Levelized. The other thing we want to do is when we're building a premium finance model out, every year we're going to have to go back and we're going to have to ask for the interest payments. And the way we're modeling today is that instead of going every year and saying, hey, year 1 is, let's say, 72,000, year 2 is going to be 87,000 and so on, what we do is we take all that interest, we take a little bit of principal in the special math equation that we created, and then we simply divide it over 10, and let's say it's $100,000. This way, it's $100,000 every year for the next 10 years before we exit the strategy. Of course, if a stage 5 hurricane hit this thing, it may require a little bit more, but it would have to be a very big stage 5 hurricane. And then as the structure of this policy, once again, there's a lot of premium finance model companies out there. And if you work with the correct one, we ensure that we've stress tested it going all the way back to the Depression. So you want a company that can model that far back and still be safe. And finally, on the dangers is the lender. There's a lot of lenders in this space. I don't know, 35, 42. I haven't counted all of them. And that's all they do. They specialize in letting clients borrow premiums for life insurance products. But not all of them are created equal. And the ones that we're looking for, of course, are the ones that have been around for a long time, 50, 75, 100 plus years. Those that are publicly traded, and those that won't call the loan at any time. So those are some of the dangers of premium finance. My name is Sal, and thank you very much.